You want to start investing. You open the app, you go to buy something, and immediately you hit a wall of words nobody ever explained to you. Index funds, ETFs, mutual funds. They sound like three different things you're supposed to choose between, and picking wrong feels like it might cost you. Here's the good news. It's way simpler than they make it look, because two of those three words aren't even the same kind of thing as the third. Once you see that, and I'm going to draw it for you like someone should have drawn it for me, the whole thing collapses from three scary choices into two easy ones. Let me show you. Quick note if you caught the last video, this is the table where the odds are on your side that I promised to show you how to actually sit down at. This is it. If you didn't see it, no problem. You don't need it for any of this. So start with the oldest one, the mutual fund. It's been around about a century, and the idea is simple. A bunch of people pool their money into one big pot. A professional manager takes that pot and buys a whole basket of stocks with it, dozens, sometimes hundreds. You don't own the individual stocks, you own a slice of the pot. So with a single purchase, your money is spread across a lot of different companies instead of riding on one. That part is genuinely great. If you put everything into one stock and that company blows up, you're wiped out. But if you're spread across 200 companies and one blows up, it's a scratch, not a fatal wound. That spreading out has a name, diversification, and it's about the closest thing to a free lunch that exists in investing. Here's the catch, and it's a big one. That professional manager does not work for free. They take a fee every single year, often somewhere around 1% of everything you have in the fund. And they take it whether they crush it or whether they completely tank your money. 1% doesn't sound like much. Let me show you what it actually does. Say you put $10,000 in and leave it for 30 years. At a normal market return, that could grow to somewhere around $75,000. But run the exact same thing with a 1% fee quietly skimmed off every year, and you might end up closer to $57,000 instead. That gap, call it $18,000, $19,000, is more than you originally put in. Gone. Not to bad luck, to fees. And what is that manager doing to earn it? They're trying to beat the market, to pick the winners, dodge the losers, and get you a better than average result, which sounds worth paying for, until you look at whether they actually pull it off. Here's the number that cracked the whole industry open. Over a long stretch, say 15 years or more, the large majority of these professional managers failed to beat the plain, boring market average. Not a few of them, most of them. People who do this full time, with research teams and expensive data and Ivy League degrees, lose to a simple benchmark most of the time. Why? Two reasons. One, beating the market is genuinely brutally hard. For you to win, someone equally smart has to be on the other side, losing. Two, even when a manager does squeeze out a little better than average, that fee eats the difference. So you're paying a premium for a result that, more often than not, ends up worse than doing nothing clever at all. So back in the 70s, a guy named Jack Bogle asked a question that sounds almost too dumb to be smart. If the pros usually can't beat the average anyway, why are we paying them to try? Why not just buy the average itself? And that's the index fund. An index fund doesn't hire a genius to pick winners. It just buys everything in a given slice of the market and holds all of it. An S&P 500 index fund owns a piece of all 500 of the biggest companies in America. You're not betting on which one wins. You own all of them at once. When American business grows over time, you grow right along with it. You're not betting against a house that's rigged to win. You own the whole thing and let it compound. That's the entire move. And because there's no expensive manager in the middle trying to be clever, the fee is tiny. We're talking a few cents per $100 a year, instead of $1 or more. Flip that fee example around, and now those tens of thousands of dollars stay in your pocket instead of theirs. So at this point, you're probably thinking, great, index fund beats mutual fund, case closed. But that's not actually the choice you're making. And this is exactly where almost every beginner gets tangled up. Here's the trick nobody bothers to tell beginners. An index fund is not a different thing from a mutual fund. It's a different strategy that can live inside one. Picture two totally separate ideas. The first is what the fund buys. Does it try to cleverly pick winners? That's active. Or does it just buy the whole market and hold it? That's index. That's a strategy. The second idea is how the fund is packaged and how you actually buy and sell it. And that's what a mutual fund is. It's a container. So here's the part that surprises people. You can have an actively managed mutual fund, or you can have an index mutual fund. Same container, totally different strategy inside it. Index and mutual fund were never rivals. One describes the strategy, the other describes the box it comes in. Which means those three scary words were never three options standing in a line. They collapse into just two questions. Question one, active or index? Do you pay someone to try to beat the market, or do you just buy the market and stop worrying about it? For the vast majority of normal people, the evidence points hard in one direction. Just buy the market. Question two, which container do you want it delivered in? And that, finally, is the real index fund versus ETF question. Because an ETF is simply the other container. So picture this. An index fund and an ETF can hold the exact same 500 companies, run the exact same buy everything strategy, and the only real difference is the container they arrive in. Here's what actually changes for you day to day, and it's really just three things. First, how you buy it. A mutual fund trades once a day. You place your order, and it fills at a single price calculated after the market closes. Everyone who bought that day gets that same price. An ETF trades like a stock, live, all day long. You can buy it at 10 in the morning at whatever the price is right then, or 2 in the afternoon at a slightly different one. For a long-term investor, though, this barely matters. You're holding for years. Whether you got the morning or the afternoon price on one particular Tuesday is noise. Second, the minimum to get started. A lot of mutual funds make you show up with a minimum deposit before they'll let you in. $1,000, sometimes $3,000. For someone just starting out, that's a wall. An ETF has no such thing. You can buy a single share. And most brokers now let you buy a fraction of a share, which means you can literally start with $5. That is the entire difference between starting today and telling yourself you'll start once you've saved enough. Third, and this one only matters in a regular taxable account, not a retirement account like an IRA. ETFs tend to be a little more tax efficient. The way they're built quietly hands you fewer surprise tax bills along the way. Don't lose sleep over this one. Just file it away as a small point in the ETF's favor. Put it all together, and for most people starting out, a low-cost index ETF is the smoothest on-ramp. No minimum, buy one share or a piece of one. Cheap, tax-friendly.
But, and I want to be clear here, an index mutual fund is just as good if your broker lets you set up automatic monthly contributions and then forget about it. Same engine underneath, slightly different dashboard on top. Don't agonize over it. Now, there's an objection I can feel you forming, so let's deal with it head on. Isn't just buying everything kind of lazy? Won't I miss out on the next huge winner if I don't even try to pick it? Here's the flip nobody tells you. When you own the whole market, you don't miss the next big winner. You automatically own it. Whatever the next monster company turns out to be, if it grows inside your index fund and drags your whole basket up with it. You don't have to guess its name in advance. You just have to already be holding the basket it lands in. Boring isn't the price you pay to stay safe. Boring is the strategy that quietly wins. So let me make it stupidly concrete, because it depends is a cop-out. If you want the entire US market in one purchase, there are total market index funds that own basically every public American company at once. If you'd rather stick to the 500 biggest, there are S&P 500 index funds. The big providers, Vanguard, Fidelity, Schwab, all sell versions of these as ETFs and as mutual funds, all for next to nothing. I'm not telling you which exact ticker to buy. I'm telling you the whole category exists. It's cheap and it's boring on purpose. And if you only check one number before you buy, check the expense ratio. That's the yearly fee. You want it tiny, a fraction of a percent. That one little number quietly decides who ends up with those tens of thousands of dollars down the road, you or the fund company. That's the secret nobody trying to sell you something wants you to hear. The winning move, for most people, most of the time, is aggressively boring.
Own a slice of the whole market, pay almost nothing, add to it every single month. Then go live your life and let 100 years of business growth do the heavy lifting for you. You don't have to pick the winner. You just have to own the whole table. So let's untangle the whole thing one last time. Index versus active is the strategy, and boring usually wins. ETF versus mutual fund is just the container. Pick whichever one your broker makes easiest and move on. Those 3 intimidating words were never 3 choices. They were 2 easy ones wearing a disguise. And that's the whole thing. One purchase, hundreds of real businesses, fees that round down to nothing, time working for you instead of against you. There's just one thing standing between you and actually doing it. You need somewhere to buy this stuff. So in the next video, I'll walk you through opening your very first brokerage account. The real screens, the real buttons, start to finish, in about 10 minutes. If this made 3 confusing words a lot less confusing, that's the whole job. I'll see you in the next one.